What if I told you that you could invest in the stock market with confidence, safety, and long-term success without needing to predict the future or chase hot stocks? This is exactly what Benjamin Graham, the father of value investing, taught in The Intelligent Investor. Today, we'll explore his complete investment strategy for defensive investors, the kind who want to grow their wealth without losing sleep at night. Graham understood that not everyone has the time, temperament, or expertise to analyze every stock. So he proposed a set of powerful, simple rules designed to help ordinary investors build a strong, resilient portfolio. The goal? Avoid risk, avoid hype, and focus only on quality and value. Let's break down how he suggested you do that, step by step. Graham offered two ways for defensive investors to invest. Option 1. Buy equal amounts of the 30 stocks in the Dow Jones Industrial Average. This gives you instant diversification, a mix of strong companies and historically stable returns. Back then, investing $16,000 could build such a portfolio. Today, it's as simple as buying a low-cost index fund that tracks the whole U.S. market. Option 2. Apply a strict 7-point checklist to select only the safest, most reliable stocks individually. Let's look at that checklist. It's the heart of Graham's timeless strategy. Graham's criteria focus on two things: quality and value. 1. Adequate size of the company. Minimum $100 million in sales for industrials or $50 million in assets for utilities. 2. Strong financial condition. Current assets must be at least 2x current liabilities. Debt should not exceed net current assets. 3. Earnings stability. Positive earnings in each of the past 10 years. 4. Dividend record: uninterrupted dividends for at least 20 years. 5. Earnings growth: at least 33% growth in earnings per share over 10 years. 6. Moderate price to earnings, PE. Ratio: PE should be no more than 15x the average of past 3 years' earnings. 7. Moderate price to book, PB. Ratio: price was 1.5x book value. Bonus rule: PE x bar PB was 22.5. These rules eliminate weak, risky, or overpriced companies, leaving only those that stand on strong fundamentals. When Graham applied this to the Dow Jones stocks in 1970, only 5 out of 30 passed all 7 tests. These were American Can, AT&T, Anaconda, Swift, Woolworth. He estimated that maybe 100 companies in the entire market would qualify. That's how strict yet powerful this filter is. But what if you want more comfort and stability? Graham pointed to public utility stocks as the perfect fit for the defensive investor. These companies are regulated, stable, and pay strong dividends. Compared to industrials, utilities showed smaller price swings and higher yields, making them an ideal low-risk option. Today, you can gain exposure through utility ETFs like SPDR, XLU, or IDU. Graham's strategy is not about beating the market, it's about not getting beaten by it. By focusing on high-quality, fairly priced stocks and avoiding speculation, you reduce risk and increase peace of mind. Whether you use index funds, screen for individual stocks, or invest in utilities, his advice remains as powerful today as it was decades ago. If you're a long-term investor seeking consistency over chaos, this is the roadmap to follow. Remember, in the short term, the market is a voting machine, but in the long run, it's a weighing machine. If you found this breakdown helpful, hit like, subscribe, and drop a comment below. Would you prefer a DJIA-style portfolio or to handpick using Graham's rules? Thanks for watching, and stay intelligent in your investing.